After years of ETF investing, the costly mistakes I wish I avoided. Here is something that took me years to fully appreciate. Choosing a good investment is only half the battle. You can own a low-cost ETF, invest consistently, diversify across thousands of companies, and still make decisions that quietly destroy the strategy. And the strange part is that many of these decisions don't feel reckless when you're making them. They feel responsible. You sell because the market looks dangerous. You switch funds because another one performed better. You buy more because everyone seems to be talking about it. Each decision has a story behind it, and sometimes that story is exactly what costs you money. The first mistake is trying to make your long-term portfolio behave perfectly in the short term. Markets don't work that way. Imagine two investors investing similar amounts into broad market ETFs. The first accepts that markets will fall sometimes. The second watches every headline, checks the portfolio constantly, and becomes uncomfortable whenever the market drops. When stocks fall 20%, the first investor thinks, this is painful, but this is part of the plan. The second thinks, maybe something has fundamentally changed. So, they sell. Then the market eventually recovers. Now comes the painful part. They have to make another decision. When do I get back in? This is where a temporary market decline can become a permanent investing mistake. The problem wasn't necessarily the ETF. The problem was abandoning a strategy during the exact period when discipline mattered most. And that leads to a second mistake, believing that doing something is better than doing nothing. Investing creates a strange psychological pressure. When markets are rising, you feel like you should be buying more. When markets are falling, you feel like you should be selling. When another ETF is outperforming yours, you feel like you should switch. There is always something to do. But sometimes the most intelligent decision is incredibly boring. Do nothing. That sounds simple until your portfolio is falling and financial news is screaming that the world has changed. This is why investor psychology matters so much. Loss aversion makes losses feel more painful than equivalent gains feel satisfying. Recency bias makes whatever happened recently feel like it will continue forever. FOMO makes yesterday's winner look like tomorrow's obvious opportunity, and overconfidence convinces us that we can recognize the turning point before everyone else. You don't need to be irrational to fall for these biases. You only need to be human. But there's another ETF mistake that looks harmless. Owning too many ETFs because you think more funds automatically means more diversification. It doesn't. You might own 10 different ETFs and discover that many of them contain the same companies. You could have a broad market ETF, a technology ETF, a growth ETF, a dividend ETF, and several thematic funds, and still have a portfolio heavily concentrated in the same underlying businesses. More tickers do not necessarily mean more diversification. The real question is not how many.
Sometimes, people spend enormous energy searching for an extra percentage point of investment return when improving their savings rate or financial stability would have a much bigger impact. The goal isn't to build the most impressive portfolio. It's to build a financial system you can survive. Because eventually, every serious investor faces a moment when the strategy gets tested. Maybe the market crashes. Maybe your favorite ETF underperforms. Maybe the financial media predicts disaster. Maybe someone you know suddenly makes money in an investment you don't own. That is when your real strategy reveals itself, not when everything is going up, when everything feels uncertain. So, what does a better approach look like? First, understand what you own. Don't buy an ETF simply because the name sounds diversified or because someone online calls it the next big opportunity. Second, understand your costs. Fees, taxes, trading costs, and unnecessary turnover can all matter. Third, separate long-term money from money you may need soon. Fourth, decide in advance how you will respond to market declines. Don't wait until you're staring at a 30% loss to decide what your philosophy is. And finally, make your investment strategy simple enough that you can actually stick with it. Because simplicity isn't laziness. Sometimes simplicity is what protects you from yourself. The uncomfortable truth is that investing doesn't reward intelligence as reliably as people think. It rewards consistency. You don't need to predict every crash. You don't need to identify every winning sector. You don't need to own the perfect ETF. You need a strategy that matches your goals, your time horizon, your risk tolerance, and your real financial life, and the discipline to stay with it when doing so becomes emotionally difficult. After years of studying investing, one conclusion keeps becoming more obvious. The biggest threat to a good investment strategy isn't always a bad investment. Sometimes it's the investor standing between the strategy and its intended outcome. So perhaps the question isn't, what investment will make me rich? Maybe the better question is, what mistakes could prevent a reasonable investment strategy from actually working? Because wealth isn't always built by finding extraordinary opportunities. Sometimes it's built by avoiding ordinary mistakes for an extraordinarily long time. And in investing, avoiding the wrong decisions may be one of the most valuable decisions you ever make.